Fed held rates steady and indicated that one cut is coming later this year instead of the 3 that had been previously forecast. So how will a higher for longer rate environment impact M&A activity and IPOs? Joining us now is John Chirico. He's Citi's head of investment banking North America. John, it's great to have you on the show. I'm going to start right there. Higher for longer. We actually kicked off the hour talking about this idea that you have a business environment, an investing environment that essentially represents a new normal. What are the conversations you're having with clients right now? What does this mean in terms of some of these flows, whether it's into IPOs or M&A or otherwise?
It's a pleasure to be here. Thank you very much. I think when we think about corporates, they tend to look at the 10-year as they plan out their planning horizon for business models, for M&A, and ultimately when they look at what their performance will be if their new companies listing are coming public. If we look at the beginning of the year, 5 cuts expected, we were sub 4%. Now we're sitting roughly at the 440 level from a 10-year perspective. So there isn't an expectation that we're going to get material movement in the rates that really impact them from a cost of financing perspective. There's modest improvement in front of us. But most models are really going to work just fine at that 4 to 4.5% all-in Treasury level, and anything that dips below that will be terrific. So I don't think these companies' performance is really keyed as much to rates as we might think as we drive forward. It's going to be more about earnings growth and their ability to generate cash flow. What we're noticing about investors is a real focus on profitability. So we want growth, but profitable growth. And we want profitable growth that ultimately ends in cash flow. So those are the models that I think are going to be particularly focused upon from a IPO perspective. And when you look at M&A, there's going to be that real focus on how does this affect our cash flow and our cash flow growth as we move forward. Okay.
I do wonder, though, if you are looking to raise capital, does this change the calculus on how you do it? I mean, you've got equity markets trading at record highs right now, and then, debt markets that are more expensive than they were a couple of years ago.
Yeah, I think more expensive than they were a couple of years ago, but I think that reset had taken place already, and there's been a significant amount of debt financing that's been driving our markets. If you look at our investment banking wallet that all investment banks are competing for, it's been more debt capital markets focused and a bit less M&A and equity capital markets than we would have thought coming into the year. So I think folks have been taking advantage of where rates are already and building in a cap structure that really works as we move forward. The real key is productivity. I mean, we've talked about AI. We just saw Broadcom's results. So as you look at these companies moving forward, immediate beneficiaries are the folks who are providing solutions to corporates. But the broader impact is going to be those corporates themselves as they implement some of these solutions, AI and other software solutions that are really going to drive productivity. And we're seeing that in forward earnings projections as we move forward. So we do think these companies are well positioned to perform.
John, I wonder what the impact of this environment is going to be on IPOs and M&A. I mean, it's what feels to me like a rare environment where the overall indices are at record highs, but a lot of startups don't feel like it's that friendly to come public. And I wonder, does that make it more of an opportunistic environment for M&A with some of the smaller company valuations not necessarily seeing the same kind of boost that the mega caps have gotten?
Yeah, and so entering into the year, our view at Citi was very much one of it would be a better year than the prior year, particularly around IPOs, but this is going to be a steady build into 25. The folks that we're talking to, there's a significant amount of funnel activity that's getting ready for that 25 level. And again, that's not driven as much by rates as what they need to do to be ready to be public companies. I think if we look back at some of the mistakes that were made earlier at other IPO real rallies were the companies ready to produce results and to do it in a way that they can be well-tracked public companies. I think folks have learned from that, and there's a real focus here, not on blitz growth, but instead profitable growth, cash flow growth, and that's going to push us towards certain types of companies initially, but we do see steady improvement throughout the remainder of the year. and then a really strong 25 for the IPO market.
Still unclear, though, at least from where I sit, what investors are looking for, because you mentioned there's an increased focus on growth versus profitability to garner investor interest. And Rubrik, which is growing nicely but isn't profitable, it was up after results in overtime yesterday, but then down during the session today. What do investors want?
Yeah, I think they definitely want to know that they've got transparency into growth. It's okay into profitability. They're okay if companies are going forward and investing, using cash flow to ultimately generate growth and profitability in the future. But that transparency is going to be very important, and a business model that they believe can ultimately deliver. This is one of the reasons why we think software as a business model will be one, particularly in 25. These are models that have been proven. And so your ability to hit milestones once you're on that track will be particularly strong. And so we do think that's one of the end markets very broadly, whether AI-driven or just the traditional software market, where we expect to see a significant amount of activity.